We all know there's going to be a lot of pain and losses to the financial system from the commercial real estate bubble a couple years ago. What we don't know and are struggling to find out is how that pain will be shared in what ultimate fashion. There are a couple of pieces of information which came out just a couple days ago that suggest it's going in the wrong direction. Now, the CRE bust could go pretty well. It really could, meaning that those investors who got swept up in the euphoria take most of the losses. Maybe some more banks go down, but the ultimate unwinding process goes relatively smooth and orderly. Now, it might get uncomfortable for a time, though ultimately the economy emerges largely unscathed. However, it could also get ugly and possibly spiral into something more and more damaging, affecting the financial system all around the world as the system is forced into a more chaotic and disorderly unwind. It all comes down to price discovery. Does it happen smoothly, orderly, methodically? Or does it start coming apart through forced liquidations, where fears and emotion drive short-term thinking, the idea that you just dump it no matter what? Thus far, nothing is happening, or very little is happening. And now that's by design, if you call it that. It's basically extend and pretend. But behind that facade, we don't know how it's really going because there is so little information. But little by little, some things are bubbling up from the shadows. And as I said, a few of those things bubbled up just in the past couple days, and they are of the wrong variety, going in the wrong direction. So let's start with just a couple days ago from what Bloomberg reported about a CLO structure. Commercial real estate has been behind the eight ball for some time now, for all those pandemic fallout work from home reasons we've heard. But now there's a really bad sign as to how deep the hole goes. For the first time since the financial crisis, and they mean the 2008 not financial crisis, investors in top-rated bonds backed by commercial real estate are getting hit with losses. And that's the big thing. Top-rated bonds, senior-level tranches. Continuing. Buyers of the AAA portion, the senior, of a $308 million note backed by the mortgage on a building in Midtown Manhattan got back less than 3/4 of their original investment after the loan was sold at a steep discount. It's the first such loss of the post-crisis era, says Barclays. As for the 5 groups of lower-ranking creditors, they got wiped out. Market watchers say the fact the pain is reaching all the way to top-ranked holders, overwhelming safeguards put in place to ensure their full payment, is a testament to how deeply distressed pockets of the U.S. commercial real estate market have become. So let's back up here. What are we talking about with all of these various groups of creditors? These are essentially securitization products or securitized structures. You have the top-rated senior pieces, which make up the vast majority of the overall par value, and those are the ones that are most protected from losses because all of the tranches above them, or below them, however you structure it, they take losses first. So if you own a AAA rated piece, it's AAA rated because there's a lot of credit protection, including over collateralization, above you, which means losses go to the equity piece, then the mezzanine tranches, and then maybe another senior piece if there is one before it ever gets to the super senior or the AAA rated part that's really supposed to not take any loss. That's why it's AAA. So what they're saying is this note had to be sold at such a discount. Not only did it wipe out the equity, which is basically expected to happen in any type of loss scenario, it wiped out the mezzanines too, maybe wiped out some seniors that were above, and even it got so far as that it eroded 25% of the senior or super senior AAA rated tranche. That's just not supposed to happen. And as Bloomberg was saying, that suggests the level of loans or level of losses are deeper than most people are fearing, most people are expecting. And that's where it gets really sticky because if we see senior pieces of these CLOs start to take these serious losses, I mean, 25% is enormous. Does that lead to other people around the system starting to sell? Now, this is one thing that we talked about previously with CRE, how CRE sponsors or CLO sponsors that have commercial real estate exposure have been buying back defaulting loans, not wanting to risk this exact type of situation. Now, to be very clear here, there isn't any sign right now that things across the system are getting bad, that, CLO spreads remain relatively tight. In fact, a lot of CLO spreads are exceptionally tight. So the marketplace itself hasn't seen any type of fallout. But this is just something that's popping up recently. As they said, this is the first time this has happened since 2008. So we have to wonder, if this is the first test, how much of that tight spread tightening and demand for CLO products is due to this extend and pretend process? How successful have managers been in hiding the scale of the problem? And by hiding the scale of the problem, well, let's go back to Bloomberg from the early part of May, talking about what CLO managers have been doing, trying not to have losses hit their structures. As delinquencies on multifamily mortgages pile up, lenders who had bundled those borrowings into securitizations known as commercial real estate collateralized loan obligations, that's the CLO, are racing to stave off trouble. To keep the share of bad loans from spiking too high, a development that would cut the issuers off from the fees they collect on the CRE CLOs, they've been furiously buying them back. The lenders acquired $520 million of delinquent credit in the first quarter, a 210% increase on the same period last year, at least according to estimates by JP Morgan and Chase Company. And they're financing these buybacks by borrowing from banks. And banks are lending on this horrible collateral, these delinquent loans, or maybe close to delinquent loans, because banks are in it, this extend and pretend strategy, along with everyone else. They're giving them warehouse financing, which is a sort of line of credit, in order to buy back these loans, just so that we don't have the situation develop like we just talked about in the other Bloomberg article, where we're taking 25% losses on the senior pieces. That's bad news for the overall market, and it could start to spook people. Participants in the marketplace are looking at their AAA rated investments and saying, am I really at risk here? Because there should be very little risk in a AAA rated senior tranche. And if we've already got 25%, yes, it was a little one, but maybe this is just the tip of the iceberg. Maybe I need to start selling my CLO, whatever part I have, just dump it into the marketplace. It could trigger that liquidity or liquidation backlash that leads to liquidity drying up, which leads to more liquidations and more liquidity drying up, and you get into that vicious cycle, which leads to the worst outcomes. So the reason banks are conspiring with CLO managers is quite simple. It's extend and pretend. Basically trying to just survive as long as possible until conditions become maybe more favorable. Maybe the economy starts to pick up. Maybe the Fed starts cutting rates. Maybe bond rates go much lower. The conditions, they're trying to choose the right conditions in order to unwind these situations. And those conditions are not today, because no matter what they tell you, the economy's not great, which CRE is heavily exposed to economic factors, and interest rates still too high for a lot of financing deals to make them make sense. Now, with the bond rally last year, it did lower some of these warehouse financing costs just enough that it makes it somewhat economical for managers to do this buyback option, to purchase back these delinquent loans rather than assign them to the investors in the CLOs. But it's all basically intended on the same strategy. And if we're starting to see losses tick up, or losses start to be booked in these CLOs, what will be the liquidity outcome? That's the question we have moving forward. But it's not just CLOs. We're also seeing liquidity pressures hit some of the more traditional types of investments, like real estate investment trusts. This is another recent development. Here's Bloomberg again reporting on it. Billionaire Barry Steinlicht is convinced the real estate market will rebound with just a bit more time. Many investors in his $10 billion Starwood real estate income trust aren't so sure and want their money back now. That tension between Starwood Capital Group's chief executive, who hates the idea of selling properties at their lows, and investors who hate the idea of having their money trapped, reached a tipping point this past Thursday. The vehicle known as SREIT took the drastic step of further tightening limits on shareholders' ability to pull money in an effort to preserve liquidity and stave off asset sales, the bad stuff, liquidations. With redemption requests mounting and just 752 million in available liquidity at the end of April, the clock was ticking for SREIT to make a move. The new restrictions, which cap monthly withdrawals at 0.33% of net asset value, which would have been about 33 million in April, are much more narrow than the previous 2% limit. Starwood will cut its management fees while the measures are in place, which the firm expects will be 6 to 12 months. So again, the idea here, and again, Barry Steinlich is right, because you don't want to sell when valuations are low, but people are afraid that this thing could get out of control and they're going to end up losing money, so they want their money in the fund back. And you can't really blame them, given the fact there's no information on any of this. This is a complete blank canvas. It could go either direction. It could be like Steinlich says, everything's going to be fine. Just give it some time. The situation will heal. Or, as we're seeing in the CLO market for the first time, it could spiral out of control into forced liquidations. And if enough money gets out of these funds, that means actual liquidations in some of their assets too. That's the part that we're waiting for, the part that leads to the vicious cycle. And we're now seeing more of these pressures emerge, largely because conditions are not favorable for a commercial real estate turnaround, nor do they look to become favorable in the near-term future. And with the lack of information, this information asymmetry, investors are getting nervous. And the CLO information, the news that just came out, gives them every reason why they should be. A 25% loss on a AAA-rated senior piece. That's not a good start. Even if it's a small part of the market, it's not a good sign. We also got some estimates, for more systemic estimates, from ratings agency Fitch, who of course has a vested interest in looking at the risks of commercial real estate and trying to figure out what the loss rates might be. Their most recent estimates suggested that floating rate loans carry the highest credit risk, given most CRE sectors have shed value over their typical maximum 5-year term. Shed value is putting it kindly. Weaker issuers with higher concentration of riskier exposures could face downgrades. Lenders' retreat from offices will exacerbate refinancing risk. We haven't seen that just yet, adding to workout activity and credit losses. We forecast the overall U.S. CMBS delinquency rate to reach 4.9% in 2025, up from 2.3% as of February. So they more than doubled their loss projection since February. And 3 out of 4 U.S. conduit office loans maturing in 2024 are likely to default. 3 out of 4. Now, Fitch says, okay, we see all of these losses, and like I said in the introduction, we're still not overly alarmed by it. Credit trends in global commercial real estate loans will continue to deteriorate through 2025, which will impact commercial mortgage-backed securities, banks, life insurance companies, non-bank financial institutions, and public finance issuers, Fitch Ratings says. Losses should remain within ratings expectations for most issuers, given the wide dispersion of risks within the financial system. In other words, they're not concentrated in one sector, which would lead to these forced liquidations. So far, Fitch is becoming a little more pessimistic, raising their loan loss and credit loss estimates, but they're relatively sanguine about the systemic effects. And as I said in the intro too, that's still a possibility. We don't see anything just yet that would make us think that this is definitely going to head in the wrong direction. These are just the first couple of initial pieces that are moving in that direction rather than sticking to the orderly unwind process. It looks like there are continued and rising risks of the wrong type of unwinding. But it's still early in the process, and we still have very little information, which is a double-edged sword. If investors look at that lack of information and start being afraid of it, like they were in the 2008 crisis, which was not really about subprime mortgages, then it becomes more of a systemic issue. And the ability of the overall system to withstand this process is also in question largely because of that information asymmetry, but also because, as we went through last year, the banking crisis, there's not a whole lot of confidence and certainty about the liquidity system overall, nor should there be, given what we see across the entire world. Lots of risk aversion, and high levels of risk aversion means that liquidity providers they're on a hair trigger to get out of markets and stop providing liquidity, which then exacerbates all of these problems. The potential for a vicious cycle is much higher during these risk aversion periods, these Eurodollar periods as we call them here. Essentially, the system becomes more fragile under unfavorable conditions, which is why so many players all across the financial system are extending and pretending. And we can see that in, well, the most recent data we have. This is from the Federal Reserve's Z1, or Financial Accounts of the United States. Unfortunately, the latest figures only go through the fourth quarter of last year. The first quarter numbers won't be released until next month, a couple weeks away. But this is what we've got through the fourth quarter, and it is all about extend and pretend. According to the Z1 statistics, commercial mortgage loans increased by another $21 billion in the fourth quarter. It's basically a slowdown in commercial credit expansion. Not exactly what you have in mind for a commercial real estate bubble being burst. Banks in particular continue to extend most of that credit, $16.3 billion, but it is at least slowing down from the peak a couple years ago. When you look at it from a year-over-year rate, the change in the fourth quarter of last year was 3.3%, which seems a little bit high given the fact that of the fundamentals that we're talking about here, but that's slower than the 4.4% in the third quarter, and it was down from the peak of 9.6% expansion in the second and third quarter of 2022. So it's slowed. Credit expansion in the space has slowed down quite a lot, but it's still expanding because extend and pretend. We can't shut everything down all at once. That leads to the liquidation. So you have this low level of expansion, this continued deceleration that everyone hopes leads to that orderly unwinding process. In multifamily, it's a little bit different because of the heavy presence of the GSEs and agencies. They still expanded by $25.8 billion in the fourth quarter. This is overall debt for multifamily real estate projects. That's a little bit slower than the $28.7 billion in the third quarter. You look at the growth rates, especially for banks. Banks in the multifamily space, they're getting out more aggressively than they are in commercial real estate overall, which is, I think, backwards to how some people perceive the CRE problem. They just increased their multifamily mortgage exposure by $6.3 billion in the fourth quarter, which is down from $7 billion. Just like with commercial mortgages, the growth rates are slowing down, but they're slowing down at a slow rate. It makes the most sense given all of these fundamentals, these weak fundamentals. The economy's not great right now. Financing conditions aren't great. Risk aversion. Just hold on for dear life and wait for more favorable conditions to develop, assuming they actually do. But what other choice do you have than to assume that? The financial system is trying to engineer its own version of a soft landing. Under the most favorable conditions, maybe rates going lower, the economy being actually strong and not just being claimed to be strong by a few politicians and central bank officials. You get those types of conditions, maybe you have a prayer to start taking losses and do it in a very controlled fashion. That's what this is all about, and we see evidence of it everywhere. But there's also these non-trivial risks that it does get out of control, that liquidations do plague the system and turn it from an orderly process into a disorderly one that can go in any number of other ways, none of them good. So extend and pretend is still the major strategy that everyone is pursuing. That's still what we see in most of the evidence. But now we're getting more information about what's really happening, the degree of losses that need to be taken, and the ability of the system to absorb it. And the first step that we're seeing isn't actually a good one. As far as less than favorable economic conditions, I've been talking a lot about those because they're showing up in a lot of different places, including in the video I've got linked below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members, Eurodollar University subscribers. Till next time, take care.